Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend who is teaching him a new skill, how to be a non-emotional trader. How you doing, Dan?
I'm doing pretty well. Close on that house that I'm a reluctant
Reluctant landlord.
landlord on. By the way, I put my son on the deed. I bought it for my son because they were renting a house. Their previous landlord decided to sell because why not? Right?
Why not? Yeah,
House
market's
prices are
hot.
up.
Yep.
So they had nowhere to move because they can't find a rental now. It's really difficult not only to find a house to buy, but how to even to rent one.
Yep.
So I had to buy a house for them so they can move in. They didn't have to move in with me. Thank God.
That was the word. That was a better option than living with you, right?
Thank God after going up there yesterday, because we closed a week ago Friday.
Yeah.
And the house it's like a tornado hit it.
Yeah.
I'm just thinking that could have looked like my house.
Well, it's got to feel good to be able to help them out. So congratulations.
Yeah. So my point was, what I was trying to make is that I put his name on the deed, even though the mortgage is in my name.
Right.
And I told him, and I had him sign a lease, 1-year lease.
Yeah.
To lock him in, so all the T's and C's are spelled out.
Yep.
But I said, look, you're still paying rent, technically.
Yeah.
But your name is on the deed. So think of this as your house.
Yeah, exactly. That
rent is going towards the equity in this house. And if you ever want to buy the house at some point, I'll sell it to you for 8% below the market, as long as I can recover my initial investment.
There you go.
So don't think of it as paying rent. Think of it as paying, an investment in your own house.
That's awesome.
Because this is equity that you're building. And he said, yes, I understand. Thank you very much. And I am going to do everything I can to make sure I take care of this place.
Nice.
So my point was made.
Yeah. Good for you. Good for you.
Right.
Well, hey, one of the things I wanted to do with you, because you and I, again, we've known each other several decades, a couple of different employers. We've been talking economics and all this stuff for so long. I just wanted to lay out for you kind of 4 variables that I see transpiring and being kind of intertwined in our economy all the way out to December of 2023. So about almost 2 years. And I want you to kind of listen, poke holes, ask questions, because I do think we are in a stagflation environment already. And I think it resolves, unfortunately, with a recession. So the four variables that I want to talk about, and you can pick whichever one you want to start with: inflation, unemployment, Fed funds rates, and GDP. So those are the 4 variables that I see. Happy to talk about any of the 4 in any order you want, but they're kind of intertwined. So
let's start with the jobs.
Okay. So the jobs number, again, kind of based.
I want to show you something.
Okay.
I'm going to share my screen here for a second.
Okay.
I don't know if you had a chance to read my newsletter this week.
I did. Yeah.
Okay.
Yeah. Yesterday.
So you saw the article from Liz Ann Saunders.
I saw it. Yes.
From Schwab.
Yep.
I took some of these from her.
Yeah. I don't.
And the really interesting thing that jumped out at me from that article was that the unemployment rate lags recessions.
Right. There's always a question: is it leading or lagging? Yes.
It is lagging, and the unemployment rate usually looks the best just before a recession.
Well, you are
which is kind of counterintuitive.
You are about to see that in my outline. Yes.
Right.
All right.
So I thought that was interesting. So the unemployment rate, if it continues going down, it actually.
Yeah. Do you want to be showing something? Because right now you're showing Peloton.
Oh, I'm sorry. I thought I was.
No, you're showing Peloton.
Let me see. Hold on. I thought I was showing. Oh, I know why. You're still seeing the chart, right?
Yeah, I am. Peloton.
Okay, hold on. Yeah, Peloton we'll talk about. I've got it on my other screen. That's why. There we go.
We'll talk about Peloton in a 3rd video.
All right. So yeah, this is the chart.
That's the chart. That makes more sense. I'm like, why is he showing me this? Yes.
Yeah, it was on my other screen. So
no problem.
Sorry.
It's okay. Yeah. So,
all right. So you can see here, the gray is the recessions. You can see this is the unemployment. You can see how it reaches its lowest point just before the recession.
Yeah. So this is what I think is going on with unemployment right now. I'm just going to use the government numbers because if you start arguing government numbers, all this breaks apart. So right now, I believe the last unemployment report said 3.8%. I believe we are actually going to go lower in the short term. I think by the summer, by September, we probably touch a low of like 3.2, 3.3, something unheard of in my adult lifetime. And we will be at the bottom for a little bit. Probably by the end of the year, we're already ticking up, but again, below where we are today, because I think we have service sector and other things coming back. And then by the end of next year, I think unemployment doubles and we're over 6%. So,
all right. So let's hold on that just for 1 second.
Sure.
And take a look at this bottom chart down here. So 3.8% was April 2000. All right. At the start of the recession, it was 4.3. So it was a 0.5% higher than the trough. The number of months from the trough to the start of the recession was 11 months.
Okay. Yep.
So if you're saying it's gonna go down even further, so it's 3.8 right now, you think it's gonna go even lower?
Yeah, I think the low will probably be August, September.
All right. So here's 3.5.
Okay.
And it was 1 month before the recession.
Well, that's
here's 3.4 and 69.
There
it
you
was
go.
7 months before the recession.
There you go. Yeah. So that's probably more. Yeah.
Here's 2.5 and 53. It was only 1 month. 3.4 here was 10 months. The average was 6 months.
Yeah.
From the trough to the recession was 6 months.
Yeah. So September. So again, I think we have stagflation this year, which again means GDP is positive, although low below trend. I'm calling a low, let's just call it September. So if you fast forward 6 months, that's March. I don't think we're 6 months. I think it's more like 11 months. I think we're in a recession. I think we started official recession in, call it July, August of next year.
Okay.
So we're like 10. So we're kind of matching the extremes of this chart, 10, 11 months.
Right.
Okay. So that's number one. That's what I think's happening. I think employment gets better. Congratulations. But oh, by the way, that means inflation gets hotter.
Right.
Right. So I think inflation is not done. Again, using government numbers, because arguing them just blows all this up and I don't want to have that battle. Argument. So if you want to stop sharing, we can look at something else or look at each other. So inflation, 7.9 was the last reading. It goes up from here. I did the math. I actually did the math correcting for the rent error or housing error in their calculation. It's actually 11.2. But again, if we use 7.9, I think it goes up from here. I think it breaks double digits. I think it peaks probably July, August. So right around the time, maybe a month or two early when unemployment bottoms, I think inflation peaks. I do think it goes down from there, but I think we end 2022 above 6%. And I think we actually are still above trend. I think we're above 4% by the end of 2023. So that's my inflation. That's variable 2 of this conversation.
All right. Very interesting. I don't have my chart. I can try to find it as we're talking, but just a couple of questions on that.
Sure.
When you say inflation will, did you say peak June or
peak.
July?
Yes, peak. Yeah.
So that means,
yeah.
So that means if it's June, that means it will be in the July report.
Correct. That's what I mean. So yeah, I think it's more like July, August. So it'll be in the August or something.
So it'll be the August report.
Yeah.
That's when you think it will peak, but that
Correct.
won't be apparent until the October or November report.
Correct. Yes, it won't be validated. Correct.
Because right. I mean, you might see it in the September report, but one data point doesn't make a trend.
Absolutely right. Correct. Yes.
So it's going to be October, November before you can actually confirm that inflation has peaked.
I agree. Yes.
And when you say peaked, just to be clear, you're talking about the rate of change of inflation.
Correct.
Inflation
I'm talking about
will
this.
still be high.
Correct.
The rate of change will start to come down.
Correct. Oh, inflation will still be high. It'll still be a trend. It will still be uncomfortable. It will still be all of those things. It will just slow down. Rate of change. Correct.
Right. Right. Okay.
Okay. So we have GDP and Fed funds. Where do you want to go next?
Yeah, let's talk about GDP because there's an interesting thing I'd like to make a comment on that one also.
Yeah, so GDP really comes from my belief that we are in stagflation today, and you can't have stagflation and a recession, right? Because one is positive, one is negative GDP growth. So I believe all of 2022, the year we're in, are below trend. I think the last reading I saw was 2.3%. I think we get under 1% by the end of the year, but I think we're positive all year. I believe we are probably positive to begin next year, meaning the first quarter. And we could be starting a recession in Q2, if not certainly by Q3. And a recession is called when you have two back-to-back quarters. So it could be Q2, Q3, or Q3, Q4. We have a recession validated. And I think this recession lasts several quarters.
Okay, so first, I brought my chart up. So I want to go back to inflation for a second.
Sure.
And share. You can see this?
I can. Yep. I remember this.
This is based on the most recent one, 7.9. Everything that's in red below here is estimated. So you can see the 7.9 is February. The March number we won't know. And all these numbers we won't know. So I just guesstimated what they might be.
Yep.
But on average for the year is 6.6. And you were saying 6.
Yep.
Right. So this is also from Fannie Mae. Fannie Mae is
the source
suggesting that it's going to be 6.6 for the year. And so I just distributed these numbers, and it could be higher in the beginning and lower at the end, whatever. But at the end, it comes out to 6.6. So if it works out this way at 9% the next one, right? This is what it looks like. So this is what it looks like right now. This is what the inflation curve looks like. Again, this is the rate of change.
Correct.
And as you know, it's a 12-month window.
Yes.
Right?
Yeah, so you start to roll off. Yep.
So the next report will roll off a 2.6 number. And the report after that will roll off a 4.2 number. Right? So these roll off in this blue chart. And it shows peak inflation in March, which is actually the April report.
Correct.
But you're not going to know that. You're not going to see the trend until probably June or July.
Yep.
All right. So your prediction is a little further out than that.
Correct.
And really, that really suggests that these numbers here coming up are going to be much higher than what I have.
Yeah. What I would say, again, just looking at these numbers, my feeling is those early numbers are not high enough, and the November, December numbers may be too high, right? I think it does peak and then rolls off just because of what's called a base effect.
Yes,
yeah.
That's right.
Yeah.
And that's what this chart is showing. This is nothing more than an Excel spreadsheet.
No, absolutely. Yeah.
Right. So this helps everybody understand what we're talking about that base effect and about how inflation numbers really work.
Correct.
The market is seeing this, and the Fed is seeing this too. But the Fed knows that they will be seeing this. That's why they kept saying that it was transitory. They know they're going to see this eventually, but the market is seeing this on this side.
Yeah.
So the Fed has to act.
No quitting. Yes.
So they have to continue to raise rates. We'll talk about rates in a second, but this is what it looks like right now. Now, every month when the inflation report comes out, I will update this chart, and it may push this peak inflation out further.
Yeah.
If the numbers are higher here in the beginning.
Yep.
Right. But that's what it looks like right now. This is, what this really is saying is if it follows these numbers, then the Fed could have cover to pause their rate hikes over in this period, or maybe the end of the year. But we'll talk about rates in a second. Okay. Sure. So now let's go back to GDP and inflation. And stagflation. I don't know if I have it in here, but the article that I took a lot of the stuff from, it's a really good article. I don't know if I pulled her comment about inflation, but she defines inflation. It's actually this one right here. She actually defines inflation and says that it's not going to be stagflation.
Okay.
What a recession is and isn't. So what defines a recession is a significant decline in economic activity that is spread across the economy and that lasts more than a few months. The definition of a recession is not 2 quarters in a row of negative GDP. Although many believe that it's the traditional definition, it isn't.
Okay. Well, that would got me a wrong answer on my econ test, because that is what I have always known.
Well, I think that's what it used to be, but I think that has changed recently.
Okay.
So now it's the definition is a significant decline in economic activity that is spread across the economy and lasts more than a few months. That's pretty loose definition.
Yeah, it is.
Right.
I'm gonna look that up. Okay.
Right. So this is an interesting article. It's in my newsletter from last week. If anybody sends me an email to sign up, I will send them last week's newsletter to get it started. But there's, I don't know where it is, but she also talked about that this one coming up. When we believe the current environment is better described as counter-cyclical or cost push inflation, when high prices put downward pressure on demand, then it is 1970s era stagflation. That said, is worth keeping an eye on the misery index, which was born in that era and simply adds the inflation rate to the unemployment.
Yep, I brought the misery index to my channel 90 days ago just to start whetting their appetite. Yep.
Right, and it's a really good article, and I put the link right in my newsletter.
Awesome.
Worth reading. I have a lot of respect for Liz Ann Saunders. She's pretty sharp.
Very cool.
So regarding GDP, which was the topic here, I agree with you that GDP is going to slow.
Yeah.
But I think that we are going to be in a quad 4 environment. Quad 4 is when everything slows.
Okay.
GDP and inflation will both slow.
Sure.
GDP won't slow and inflation will continue higher. GDP and inflation will both slow.
I believe we eventually get there. That is correct. Yes. Yeah. Okay. Yeah, and that is in my opinion why we have stagflation this year, because inflation is you can't argue is uncomfortably high, and growth is below trend. I think that is the classic definition of stagflation, at least from a simple definition.
Yeah.
And this ends one of two ways. You either end by growing out of it or with the recession. And I think
there's a third way it could end.
Okay.
I was curious to see if you would mention.
Okay. How's the third way?
War.
Well, yeah. Yes. Well, that's the a la 1940s.
Right.
Yeah, absolutely. Yeah. That's yes, that is a third off ramp for sure. But that, yes, correct.
Yeah.
So that's the three. So the last is Fed funds, probably, at least for my channel, the most important, because it is a driver of interest rates, cost of capital, mortgage is most important. So we have liftoff, right?
Yep.
We've had our first raise. I believe that the next one, actually, I believe the next two will be 50 basis points.
I do not disagree with that.
Yep. I don't know if you saw it, but Citigroup came out with a crazy prediction. I do not agree with Citigroup. Citigroup said the next 4 will be 50 basis points. The next 4 meetings. I don't see it.
I don't agree with that.
It is such a wild thing. I actually this morning went and looked if it's ever happened before. It happened one time before, 1994 to 95, and it led to a nasty downside where they had to reverse it. So I don't see 450. I see 2. I don't see 4.
Yeah. I see probably 2. 1 for sure.
Oh, one's locked in.
And that's kind of what I was talking about before with 4,600 being the next target.
Yep.
That the market's going to continue up next week, and 4,600 might be the resistance level,
right,
where it starts coming down, because before the April one, which is I don't know the exact.
There's
date.
a one in April. It's technically May 3rd and 4th.
Oh, really? Okay, so you got a little extra time.
Yeah,
but I think the market is going to start anticipating that 50 basis points.
Yeah, I think it's going to be 2. I think one of the things we've learned from Powell is he's following Bernanke's playbook. He's telling the market clearly what's happening. We've had 5 Fed presidents, 2 of the 5 were doves come out in the last 5 trading days and say 50 basis point is on the table. It's coming.
Mhm.
It just
Yeah.
is. That's what they're
I agree.
doing. They're running the same playbook.
I agree.
So
But if the chart that I showed for inflation
Mhm.
previously,
Mhm.
showing where peak inflation was. Now I showed peak inflation in May, let's
Mhm.
say, or
Mhm.
the trend won't be identified until June or July,
Mhm.
giving Powell cover to pause his rate hikes.
That's it.
Now
That's
according
where
to
I'm
you,
going.
it might be later than that. It might be September, October before he has cover to pause.
Exactly. So that's why I think this all ties together to me. I think there's 250 basis point raises, meaning we'll be at 1.25. I think we end the year with the Fed funds, the front end, about 2.5 to 2.75. Right. Let's call it
Okay.
2.75. That's where I'm at. End of the year.
That's a pretty average rate.
Yeah. I think we get there faster. Right. I think like a lot of this, I think he fronts load stuff so he could point at the inflation curve saying, see, we did that, when you and I both know it's just freaking math.
Yeah, that's right.
And then, so we end the year 2.75. I think we end next year at 4. I don't, and then, oh, by the way, like I said, I think we start a recession, kind of late Q2, Q3, Q4. So I think we end next year with the Fed funds rate at 4%, which will be the peak.
Okay. I don't disagree with your thesis. I would probably move the dates up a little bit.
Okay.
On most of them.
Okay.
I would say the peak inflation is going to be earlier than October.
I mean, validated earlier than
validated. October. Yeah, I think it'll be validated by July.
Oh, wow.
I think he'll.
So let me play that out. So validated in July means you've had at least 2 data points. So you have the May and June months.
Right.
Maybe.
Well, the June and July.
Oh, the June and July.
Validated in July, you'll have 2.
That makes sense. That could be.
The
So
May report will be for April. And I think April or May is where it's going to actually peak.
Okay. So I'm a month or so behind you.
So so I'm a little ahead of you.
Okay, that's fine.
Which then means that he will start to pause his rate hikes sooner than what you think.
Yeah.
But I do think we're going to hit 2 for sure.
Oh,
and maybe 2.5 by the end of the year.
Yeah. Okay. Very cool.
2.5. I think 2.5 is very reasonable by the end of the year.
Yeah. So if it's 2.5, I'll take the over.
I think the recession will be earlier than what you're predicting.
Ah, okay.
I mean, it might be Q2, but I think it will be early Q2.
Got it.
So probably May of next year.
Hmm.
And I think the recession will last. I don't think it's going to be a long recession.
Oh, you don't?
No, I don't think it will, because we are still in a
that's your thesis.
Secular bull market.
Yes.
And in secular bull markets, recessions don't last as long.
Yeah, no. Yeah, the average recession 17 months, 17 and a half, technically.
Right. So I think it'll last 6 to 9 months.
Okay.
But it will have a cleansing effect.
Oh, yeah.
And it'll be a good buying opportunity in the stock market.
Awesome.
If you're nimble enough and if you can understand the charts.
Yep.
And then we'll come out of it on the other side and we'll be off to the races.
There you go. Well, folks,
unless there's a war.
Yeah.
That could change everything.
That could change everything. Let's not hope for that. Let's hope for peace. Folks, this morning on the Daily Financial News, I teased that I was going to have these discussions. I did a whiteboard myself, which I'll post at 5:00. Now, Dan's given his thoughts. Do me a favor. Leave your thoughts below. Put comments. Where do you see unemployment at the end of this year and next, GDP this year and next, Fed funds this year and next, and inflation this year and next? Let's see where we're at. Roll the dice. Let's see what's happening. Dan, what is your newsletter one more time?
Yeah, and also I want to show Peloton.
Oh, go for it.
Okay, there's the newsletter, breakpointtrading@gmail.com.
I'm not seeing it if you're sharing.
Oh, sorry.
It's okay. You have lots of screens. There we go.
There we go. breakpointtrading@gmail.com. I'll send you last week's newsletter that has the link to Lizanne Saunders' article on inflation, which I think, or rather on recession.
Yep.
I think was very insightful.
Very cool. And do you want to just flash Peloton for fun?
Yeah. So when we talked the last time, you mentioned Peloton
I
as a
did.
potential candidate.
Mhm.
And it was 2 weeks ago.
It
So
was.
it was way down here at the bottom,
It was.
right? It didn't quite get to 20, just above 20.
Mhm.
And I said, I don't know if it's going lower. It could very well keep going lower.
Mhm.
And I suggested, why don't you put an order in at 25? And if it starts to take off, then you can catch it
the
on the
upside.
upside.
Yep.
And I showed you the chart. And the thing that jumped out at me was the accumulation distribution line down
I
here.
remember. Yeah, it just started to expand. Yep.
So the important thing is when it got up to 40 back here, when there was the announcement that Amazon might buy them.
Yeah, that was sugar high. Yep.
So the accumulation distribution, this is again the type of thing that can give you a clue to what the algorithms are doing.
Mhm.
This tells you whether big institutions are accumulating, buying, or distributing, selling.
Mhm.
They cannot get into positions the size that they need to get into in one day.
No.
It takes them weeks or months to get in and out of positions. All right. So there's a big jump here, but then as it sold off, as that news kind of waned, continued to sell off week after week, all the way down here to the bottom. But the accumulation distribution line never went below its moving average.
Yeah, they kept buying.
So the big institutions, even if they didn't keep buying, they weren't selling.
There you go.
They were holding their positions. That was the thing that impressed me when I looked at this, what you mentioned.
Yeah.
So I did what I recommended you do.
Oh, you did?
I put an order in at 25.
There you go.
And it executed right there, 25. And it's up right now. I mean, it might starting to roll over a little bit, but I have a sell order in that to give me a 6% gain in basically a week. Right?
Yeah, don't go broke taking a profit.
Yeah. But if it continues higher,
yeah,
then great. I'll just keep moving that up. Right now, I think it's at about an 8 or 9% gain in a week.
Nice.
But if it starts to come down, I'm gonna book 6% in a week or so.
Just keep putting it on the stack. Yeah, 6% a week is a great. I'd say 300% or more compounded.
Yep. Yeah. So you never know where your ideas are going to come from, and it was a good one that you identified.
There you go. I'm glad I gave it to you. So very cool. Well, Dan, thank you very much. You're helping me a lot. Thanks for your friendship these past decades as well. Thanks, buddy.
You bet. My pleasure.